It's great to welcome you to Top Forex Academy, where you gain access to exclusive training, proven strategies, and expert mentorship that have helped countless students achieve financial freedom. We encourage you to start your journey today and turn your ambitions into your realities. Thank you for visiting our channel. Kindly subscribe and sign up with our link to get 50% bonus. Also, you get 100K demo account for learning. And to get your 100% deposit for your live account, you can also use our promo code, which you will find before the end of this video. Make sure you follow through and you see yourself on the top achieving your sweet realities. Please visit our website, bit.ly Top Forex, to look up our services. Also, follow us on Instagram, Top Forex Academy. Welcome back to Empowerment Series titled Forex Basic Class Series 1, brought to you by Forex Academy and facilitated by Forexvpn. Today, we shall be looking at a very key topic in the Forex space that will help you improve and on your Forex trading skill, and that is fundamental analysis. In this lesson, we will cover fundamental analysis, which are studies of economic, social, and political factors that affect the value of currencies. Economic indicators such as GDP, inflation, employment data, and some other important factors that impact forex markets. When these indicators are released, they cause significant volatility in currency prices. Geopolitical events such as elections, wars, and trade agreements also have a significant impact on the forex market. For example, the Brexit vote in 2016 caused the British pounds to plummet, while the US-China trade war in 2019 caused the Chinese yuan to weaken. Interest rates are another important factors that affect the value of currencies. When a country's central bank raises interest rates, it attracts foreign investors and strengthens its currency. Conversely, when interest rates are lowered, it can lead to currency depreciation. Here, we have forexfactory.com, a place where you look up your Forex economic data to check and corroborate with what is going to happen in the market as you anticipate market movements to allow you to take wise decisions in your trade. Looking at all this data we have here, the question now is, how does fundamental analysis affect the forex markets? Fundamental analysis plays a crucial role in the forex market by evaluating the underlying economic, political, and socio-political and social factors that influence currency value, unlike technical analysis, which focus on price action such as price charts and patterns. Fundamental analysis assesses macroeconomic indicators, central bank policies, geopolitical events, and market sentiments to predict currency movements. We are going to be looking at the key ways in which fundamental analysis impacts the forex markets. The first to discuss are economic indicators and their impact on currency prices. Economic indicators affect a country's financial health and influence the demand and supply of its currency. Some of the most important economic indicators are GDP, which is gross domestic product. This measures the total economic output of a country. A strong GDP indicates economic growth, strengthening the currency. A declining GDP suggests economic weakness, leading to currency depreciation. Another economic indicator to look at is inflation, measured by the PPI, that's Producer Price Index, and the CPI, Consumer Price Index. These indices track inflation rates. Moderate inflation is good, but high inflation devalues a currency as purchasing power declines. Central banks respond to inflation with interest rate changes, directly impacting forex prices. which leads us to this next indicator, interest rates. Interest rates are used to implement central bank policies, and high interest rates attract foreign investors, increasing demand for the currency, while lower interest rates discourage investments, weakening the currency. For example, traders monitor central bank statements from banks such as the Federal Reserve, ECB, Bank of Japan for interest rate expectations. Another indicator is employment data, also known as NFP, and unemployment rates. Non-farm payrolls, NFP, for the US is a key job report influencing USD volatility. A strong labor market supports economic growth, boosting the currency. Rising unemployment signals economic distress, leading to currency depreciation. Another key indicator on these charts is the employment data, NFP, and unemployment rates. As you can see right here, non-farm payrolls, NFP, for the US is a key job report influencing USD volatility. A strong labor market supports economic growth, promoting the currency. Rising unemployment signals economic distress, leading to currency depreciation. I would like to quickly show us how to pick up this data from here. You can see this is time, this is the currency, and this is the impact of this currency. Each of these currency represents different economy. This is Australian dollar, Great British pound. This is Swiss francs. This is euro. This is US dollar. This is CAD. This is New Zealand dollar. This is New Zealand dollar. This is Japanese yen. This is Chinese yuan, and so on and so forth. Here we have the impact factor. When you have a yellow indication, that's little or no impact. When you have a brown indicator, that is moderate impact. And when you have a red indicator, that is high impact expected. Here is the folder showing the data. You can open them to read up how the data change with respect to time. Here you have the actual data, here forecast, and here previous. And this page before price action happens. You might want to read off the forecast and check it against the previous to know what to expect, especially with what we're going to be explaining in the course of this lesson. The next to look at under economic indicators is trade balance and current account deficits. A trade surplus, which indicates a higher exports, strengthens an economy and also its currency due to high demand. While a trade deficit in which the export is lower, in which the imports is higher, weakens the economy and the currency as more foreign currency is needed. Another key way of carrying out this fundamental analysis is looking at central bank policies and their influence on Forex. Central banks play a key role in currency valuation, interest rate decision, quantitative easing and tightening, and forward guidance. Let me explain it one after the other. Under interest rate decision, higher rates attract capital inflows, increasing demand for the currency. Lower rates encourages borrowing, but weaken the currency. Quantitative easing. Central banks print money to stimulate growth, causing currency depreciation. Tightening. Reducing money supply, strengthening the currency by limiting inflation. And lastly, forward guidance. Statement from central banks, e.g., the FOMC, like we have here, FOMC member Bowman speaks. So when you have statements like this from FOMC, ECB, BOE, that's Bank of Europe, these statements affect traders' expectation. All right. Another forward guidance that we may have is dovish guidance. Favoring lower rates weakens the currency, while hawkish guidance favoring high rates, strengthening the currency. A third point is geopolitical events and market sentiments. Political instability and global events impact currency values significantly, like elections and political instability. A stable government attracts investors, strengthening its currency, while political uncertainty or conflicts weaken confidence and cause currency depreciation. War and global crises also disrupt economic activity and often weaken a country's currency. Safe haven currencies such as USD, JPY, Swiss francs tends to strengthen during crisis. Trade war and sanctions. Trade restrictions or sanctions harm economic growth, weakening affected currency. Currency wars such as intentional devaluation can lead to forex market volatility. A fourth point in the ways at which you do your fundamental analysis is market sentiment and risk appetite. Market sentiment shift due to economic data that you can get on Forex Factory and other places, global news, and investor perception in the following ways. Some investors will have sentiments like risk on versus risk off sentiments. Risk on investors seek high yield assets such as Australian dollar, New Zealand dollar, and other emerging currencies in the markets. Risk off investors move to safe haven currencies such as American US dollar, Japanese yuan, and Swiss francs. Under this sentiment and investors' perception, we also have speculative trading, where hedge funds, institutions, and retail traders react to news driving volatility. Positive reports attract buyers, while negative reports trigger sell-offs. I would like to show you how to pick your data from here. Assuming you want to read off this very data, that is an inflation data, you can just click this folder, which will show you the data in full details. You can see that the data is now plotted from over 10 years ago to date. From the time series this data of this economy is showing you, you can use this to anticipate what might happen in the market next. It is safe to say fundamental analysis provides insight into long-term currency trends and major price movements. Traders who incorporate fundamental data alongside technical data can make better informed trading decisions. Understanding how economic indicators, central bank policies, and global events impact forex prices allows traders to anticipate potential market movements and manage risk efficiently. In fundamental analysis, news like unemployment rates, NFP data, FOMC decisions, interest rates, and so on make big impacts on the forex market, causing significant liquidity. This data can be got from sites like forexfactory.com, myfxbook.com, bloomberg.com, Yahoo Finance, MarketWatch, etc. Now let's take analogies using a trading scenario. As you have seen on the sites that we just opened, forexfactory.com, we saw that there are several currency pairs in which we can extract data such as interest rate expectation and so on to anticipate market movement in the coming periods. So we are going to show you how to follow that through, looking at it one step after the other. So the first step you want to do in using fundamental analysis is to identify the fundamental catalysts. So when you're doing so, you check the Federal Reserves to be sure that they are hinting at interest rate hike due to rising inflation in the US. You also check data perhaps to see that the Bank of Japan has maintained an ultra low interest rates to support their own economic growth. Higher US rates would make the USD more attractive to investors, increasing demand for US currency. Step 2, what you need to do now is to analyze the economic data. The latest NFP reports show strong job growth, reinforcing expectation of a Fed rate hike. Okay, now you also check the CPI, which might indicate rising inflation, further supporting the case for higher interest rates. So on our chart, we also see that the Japanese economy shows weak GDP growth, making it unlikely that the Bank of Japan would change its monetary policy. Now we now move to step 3 to see what changes or tools are we going to analyze. So the next is the market sentiment and risk appetite. You check to see if investors are in a risk-on mode. They are willing to invest in higher yielding assets like the US dollar. You also check to see if the safe haven demand for JPY is low. In such a case, it will reduce the strength of JPY. So what are we trying to say is that in that situation, you are looking at USD a stronger hand, and JPY a weaker hand. So that is what? A buy. Now let's move to step 4, which is a trading decision. Since the fundamental data favor the USD over the JPY, a trader might enter a long, same as a buy position on USD JPY ahead of the Fed's interest rate decision. So now you could put your entry points at a place where you're seeing price rejection to the upper side. So you buy USD JPY around 154, okay? And then you put a stop loss below a recent support level at around, according to what we are seeing in the historical movements, based on our fundamental analysis, and then what the price is talking about, and what the support level is currently in. The recent support level is around 153, and you take profit near a key resistance level. Let me quickly show you how that will look on your charts, or perhaps let me show you how that will look on your trading app. For this example, I'm going to be using TradingView. So as you can see on this TradingView, the decision was made around here. This is 154. This is the 154 price. Okay, you place your stop loss below the recent support. You can see the recent support is around 153.7, but you go a bit below that to 153. Okay, so after that, that is 10 points away from your entry. This is where your entry is. We can draw a line to help us see the picture better. So this is the entry side where you see price pushing up, rejecting to the upper side. Where's the stop loss? Your stop loss is below the support level, this is the support level. So you can put a stop loss around here below this place. Mind you, these levels that we are considering are higher time frame levels. So for this example, I chose 4 hours time frame. This will give you more confidence in what you're doing. And you can be rest assured that if the trade goes against you, you are losing only 10 points. But if the news come out, or if the decision of the federal banks comes out in favor of you, based on your fundamental analysis, then it goes to buy, then the price comes up, and then you make significant profit. The take profit will be close to the next resistance. So our next resistance is around here, around 158 price mark. Here, you can see. You can also draw a line there. Yes. So you can put it here. So this is our next resistance zone. where you can put your take profit. So you can see, imagine you raking this type of profit. You might trade this, and if your stop loss is not hit, your take profit might take a day or two or more to be triggered, and you clock in several pips in your favor. So you can calculate what pips that will be. From 154 price level to 158, that is more than 300 pips. I hope you can corroborate what you saw on the chart right now based on fundamental analysis to what we have taken as our trading decision. Remember, we are basing this our analysis on interest rate expectation. That's our key indicator. Step 5 will be to see the outcome and adjustments. So if the Fed raises interest rate as expected, the USD strengthens, pushing USD/JPY higher in your favor. If unexpected negative data emerges, such as weak job numbers, etc., the trade will be exited early to minimize losses. Thank you for staying this far. In the next lesson, we will cover technical analysis and how it is used in Forex trading. Thank you again for your attention. Kindly subscribe to the channel and also sign up with our link to get 50% deposit bonus on every deposit you make. Also to get a $100,000 demo account for learning. You can also get your 100% deposit bonus. It's a one-time bonus on your live account with a promo code Forexvpn. Kindly visit our website to see the varieties of our services and products. We are also launching a challenge soon. We want to dare you to see how much you have learned and how much you can gain in the Forex market. Watch out for it, and also watch out for our promo that are coming on the way. You don't want to miss anything. Make sure you share this video, share this channel, like it, subscribe, and also make your comments and let us see what you feel. Let us see how much you have learned, and let us know how much. Let us also have your question regarding any topic that you want us to treat, or any topic in the Forex space on which you need clarification. Our academy experts will be here to attend to all your queries. Long to see you again on the channel. Bye for now.